And yeah, valuations are high. There's plenty of reasons to be worried. It's scary to invest at record highs, but that's what we're doing right now. Investors keep plowing into their favorite stocks. Also, meme stocks getting a pretty big lift here. Let's see what's cooking on the Investopedia Express homepage. Hey, we got a good preview of what to watch this week. We'll get into some of that this week. We got a detailed deep dive into the crypto legislation that was passed last week. That's going to open the doors for a lot more crypto in our accounts. We'll get into that with Michael Townsend of Charles Schwab in a little bit as well. And we're going to get some previews of some big earnings coming out this week. Big week for corporate earnings. Let's see if corporate earnings can hang on in there, and preparing for tariffs, especially orange juice, coffee, and other imports coming in from Brazil. Check the Investopedia.com news headlines. Our team is all over the news that matters. Let's talk a little bit about record highs and the scariness around investing at record highs. And we know it's scary. We talked about it last week. But you know what? Your odds are better if you invest at record highs. You usually get more after that. Again, we've had 9 so far this week. Shout out to my guy Ryan Dietrich at the Carson Group for his terrific charts and analysis. Always love that. Again, the record back in 1995, 77 record highs. We had a bunch last year. But the question a lot of investors say is, don't we usually get a market crash after record highs? The answer is no, but we've had them before, and you want to be aware of that. Not that we're anywhere near what I think could be the precipice of a market crash. But let's go back in history. 1929, yeah, the Great Depression, you betcha. That was a big crash, 89% drawdown there. That lasted a couple of years until 1932. 2000, the dot-com bubble. I remember I made some of my big first investments in the dot-com bubble. Those burst all over the place, 77% drawdown after that. 2008, of course, the great financial crisis, the 57% drawdown. That lasted a couple of years as well until the Fed really floored interest rates. And then 2020, the COVID-19 crash. That was the last big crash we had, 34% drawdown. Guess what? Fed floored interest rates. Government flooded the economy and consumers with money. And we were right back off to the races, making new record highs right after that. So yeah, you get crashes after all-time highs. That's the price you pay for investing. But are we anywhere near that type of an environment today? Corporate profits pretty decent right now, right? We're getting a decent outlook from companies. They were a little bit scared going into this quarter because of the uncertainty around tariffs, and there's still a lot of uncertainty around tariffs. But it's valuation that might get your attention, because guess what? It's pretty high too. Let's see that chart from my buddy Charlie Valello, who does great work on analysis, and he's looking at the CAPE ratio, the cyclically adjusted price to earnings ratio. That kind of smooths out earnings over a 10-year period. And yes, it's pretty high right now. It's as high as it's been in 2021, wasn't as high as it was during the dot-com bubble. Valuations are high. That's what happens when you have stocks worth $4 trillion like NVIDIA. And that's one reason you might get a little scared off from record highs and big gains in the stock market. But again, the price you pay for investing, ride it through the highs, ride it through the lows, and that's the deal. Let's dig in a little bit to private markets, because guess what? They are coming to a 401k near you. When we're talking about private markets, what are we actually talking about? We are talking about private equity, private credit, real estate, infrastructure, natural resource investments, and hedge funds. And this is only about a $13 trillion market right now, but guess what? It's getting a lot bigger, and there is legislation being talked about and probably passed in the next few weeks, or certainly by the end of this year, that is going to open up private equity, private capital to investors like you and me. Typically, it was reserved for the ultra high net worth and accredited investors and institutional investors. They lowered that threshold over the past couple of years. You need to make at least $200,000 in income and have $1 million in investable assets. But retail investors don't really play around a lot with private equity and private capital. Why? There's less transparency. But this market is big and getting bigger. There are estimates that say it's going to become a $30 trillion market in just the next few years. And as legislation eases to let it into our accounts and give us access to it, well, you're going to see all that market get a lot bigger, and it's global. We're talking about investing sometimes in private companies or in companies that invest in public companies, take them private, take them apart, sell off the things that aren't making money, spin them back out, or merge them with another company, and you're going to get access to that as well. But we're also talking about real estate investments, not REITs, not necessarily, not buying homes necessarily, but by buying into big real estate projects that are typically run by private equity firms or hedge funds. One of the biggest firms in the world, Blackstone, is one of the biggest real estate investors out there. So what could go wrong? Well, There's not a lot of transparency in private markets, and maybe that's what this regulation is all about. Again, we'll get into that in a couple of minutes with the drop in with Mike Townsend of Schwab. But another big reason that private capital is making its way into our portfolios eventually is that there's just less public companies out there. The number of public companies almost cut in half over the last decade or so as firms are choosing to stay private. It's a lot easier to stay private and not have to report your results all the time. We got a lot of mergers. We got a lot of companies that are finding ulterior ways to raise capital, not necessarily through an IPO, but also you're looking at companies that maybe just don't want to participate in the private markets and such. And now there are new developments that are allowing public investors, retail investors to invest in private companies. There are exchanges that are opening this right up. Forge is one of them. If you want to invest in companies that have yet to go public, we're talking about the OpenAIs of the world, the Perplexities, even the SpaceXs of the world. These companies are allowing you to access those as if they were securities. They're not quite public securities yet, but you can invest in them. And the problem is, again, not a ton of transparency with these companies. Some of them are pre-profit. A lot of them make big revenue, especially the AI ones. But if you want access to it, you can already access them as securities, kind of like stocks, but without the total transparency and the supervision of the SEC. So it's happening, and it's happening fast. Let's get into a lot of the policy changes that are really turning the tables on what was traditional investing for you and me, individual investors out there. Let's bring in Michael Townsend. He is the managing director of regulatory and legal affairs for Charles Schwab. I learned so much from him. He's coming in the drop in just a couple of seconds. Good to see you, Michael. Thanks so much for coming back on the Express.
Hey, Caleb, it's great to be with you.
When I need to learn about policy, I listen to your terrific podcast, Washington Wise, but I also read your notes. Great analysis by your team because you follow this super closely. And there are so many developments. I want to hit 5 or so of them real quick in the time that we have. Let's talk about the big, beautiful tax bill, as it's called, around Washington, D.C. There's a lot in there, as you know. It's pretty massive. It's like 3 or 4 phone books. But what's the most significant development for long-term individual investors like me and our viewers?
Yeah, Caleb, I think the biggest thing is just the clarity that we have on taxes for a long time to come. Individual income tax rates, permanent. The standard deduction, higher standard deduction, permanent. The higher child tax credit, permanent. The estate tax, which is going to go to $15 million in 2026, and then be indexed to inflation after that. That's great for planning. We know where the estate tax has been bouncing all over the place over the last 10 to 15 years. So I think that's really, really significant. And even the shorter term ones, the campaign proposals, no tax on tip income, no tax on overtime hours, even those only last for 4 years. But I'll tell you, Caleb, I'm guessing that no tax on tip income is going to be pretty popular. That $6,000 extra deduction for seniors, I bet that's going to be pretty popular. So come 2028, when that expires, boy, it's going to be hard to turn those off, given how popular I bet they're going to be. So I think that's really important for investors, just have real certainty on taxes for a long time to come.
I remember speaking to you last year, and you say the one big gray area is what's going to happen with estate taxes, what's going to happen with estate planning, and this does clear the way for that. There's a lot in there as well. Let's talk about private capital. I was just getting into it a little bit, and the size of the market and how it's being opened up to retail investors. That wasn't always the case, as you know. You've been watching this for a very long time. What should we know about private capital markets, individual investors like us, and what could go wrong if we're investing in them, whether it's through platforms like a Forge or whether it's through our 401ks? Because I think there's legislation that might open up private capital, private equity into our retirement account.
Yeah, I mean, that's the first thing we're watching. The president has indicated that he's going to do an executive order that would allow private markets to be a part of a 401k. But keep in mind, Caleb, that I don't expect a big rush to the doors for this. This is going to be really carefully answered by plan sponsors who are ultimately responsible for deciding what investment options are in a plan. And it might be right for some plans. You got a lot of plans out there that have very, very wide array of options, and just allowing more investing options is a good thing. I think But you also have plan sponsors who are going to probably take a very, very slow and careful look at this. So I don't expect like overnight that you're going to see a huge explosion of private market options in 401ks. And then the other thing, and you talked about this in your opening, is the SEC is planning, I think, to change the definition of accredited investor. In fact, the House is going to vote on a bill this week that would change the definition of accredited investor and probably make it easier for investors who maybe don't have all the assets that have traditionally been needed for that type of investment to make that more accessible to smaller, more ordinary investors. But I think again, it's going to be a process to really watch, because it only is going to take one thing going totally sideways to really spook investors from this. So I think it's going to be a kind of a slow ramp up.
Yeah, and to be clear and to be sure, obviously, there are ways you can access private capital and private equity as a retail investor today. There are ETFs that track that market. You can invest in firms that are really specializing in private equity. I talked about Blackstone as being one of them. There are some massive public firms out there. This is kind of what they do, and you can invest alongside of them. But the fact that more of this will be accessible to retail investors is notable. It's also in light of the fact that crypto is being opened up more to retail investors. So all of a sudden, we went from a world where it was stocks, bonds, commodities, fixed income, and crypto, which has been around a while, to all these other asset classes that are going to give us more choices as retail investors. Good question here from Santiago. Is money being carried from share stocks to crypto right now? Well, I don't know. There's a lot of people out there that have been skeptical of cryptocurrency, but the crypto market's been open, Santiago, for quite a while through ETFs, by spot ETFs. But let's talk, Michael, about the passage of the Genius Act and the Clarity Act. Those are two important stablecoin regulatory acts that were passed last week, going to be signed by the president, if not already. How are they paving the way for more stablecoin and crypto adoption by retail investors? And what do we need to know about them in terms of how safe or safeguarded they might be now that they're could be part of the law?
Yeah, Caleb, I think this story goes back to the beginning of 2024 when the SEC approved the first Bitcoin ETFs. That really changed the game. Suddenly, ordinary investors had easy access to crypto without, sort of opening a wallet and going through one of the crypto exchanges. And I think Congress and the regulators realized at that time that crypto is here to stay, and we need to put some regulatory structure around it. We need to put some investor protections in place. So last week we saw the stablecoins bill, now the law of the land. The president signed it into law on Friday. And it allows, among other things, it requires that crypto stablecoin issuers back with one-to-one with either dollars or highly liquid assets. So that should give investors some confidence. But again, I think we're going to have to wait and see how sort of adoption of stablecoins goes mainstream. I don't think that's going to be an overnight process either. I think there's a lot of skepticism still out there about, are stablecoins going to be something important that I use in my day-to-day life? And I don't think a lot of investors are there yet. So there's sort of this separation of the investing opportunity between the use opportunity. And then the second bill is the one that is sort of a broader market structure for crypto and really putting in place a regulatory structure, deciding who's in charge here of overseeing it. Really gives a lot of responsibility to the CFTC, the Commodity Futures Trading Commission, secondary responsibility to the SEC. And again, I think that's ultimately, and the Senate hasn't taken that bill up yet, so there's a ways to go on that one. But that's ultimately going to be, I think, good for investors to have a structure in place that gives them more confidence about this asset class.
And we know that big retailers are very interested in potentially starting their own stable coins, the Walmarts of the world. Why would they want to do that? What is the actual use case for a retail or for anyone that wants to create their stable coin, as long as they're backing it with reserves in dollar? What's the use case that might intersect with how I operate as a consumer or as an investor?
Yeah, Caleb, you've hit one of the great questions that I think will be solved here over time is, if stable coins are backed with dollars, it sort of raises the question as to why don't I just use dollars? And everyone is so used to using credit cards and Venmo and other sort of instant payment options. I do think that the stablecoin supporters really believe that the sort of 24/7 instantaneous anywhere in the world transaction ability without any kind of middleman makes a lot of sense, and ultimately could potentially impact the credit card world because you're sort of eliminating fees and that sort of thing. So we'll see. I'm fascinated to watch this space evolve and how companies innovate. I think it's going to be really interesting to watch.
Yeah, we will see. Absolutely. You covered this so well in your terrific podcast, Washington Wise. We're going to link to that in the show notes, folks. If you want to go deep on this, you and I think I believe it was Nate over at Schwab did a great job getting under. All right, let's talk about Fed independence, because that has been under attack. We know the president is no fan of Fed Chair Jerome Powell, even though he appointed him once upon a time. And basically, he blames him for not lowering interest rates, but we all know that it's the FOMC that actually has to lower interest rates. There's 12 people voting on that, but there's some dissensions right now about when and if the Fed should lower interest rates. Fed independence. Now, we've always found it sacred, or thought it to be sacred as investors, and that's what we were taught, and that's what the Federal Reserve Act of 1914 is all about. You want your central bank to be able to adjust monetary policy to keep the economy in check, prices stable, and the unemployment or full employment, somewhere between 3.5% and 4%. Why is Fed independence so important, or is it as important as we think it is, Michael, in today's day and age in 2025?
Oh gosh, I think it's really, really important, and I think investors think it's really important. I think if you really felt like Fed independence was going downhill, you would see the bond market in particular react very strongly. I think you would have investors just demanding more compensation, and bringing yields up. So I think it's a really big deal. I've been fascinated to watch this whole story. It is the number one question I'm getting when I talk all over the country to investors, because I think they're very concerned about it. And President Trump has said for months and months and months that he wants to fire Jerome Powell. I still don't believe that he's going to do it. I think he likes the sort of trolling of this. But the reality is that Powell's term ends next year, May of 2026. The president is going to have the ability to appoint a new chair, and he'll go through that process, I think, and he may say who that person is quite a bit ahead of time, much farther ahead of time than is traditional. But I still am in the camp that I think it's very unlikely that he fires Powell. And you make a really important point, and I have to make this point all the time when I talk to investors. There are 12 voting members on the FOMC. The chair doesn't wave a wand and change rates. So I think the system will continue to remain strong. I'm fascinated to see who is the next chair, and we'll see what direction we go from there.
Yeah, he doesn't wave a wand and change interest rates, nor does he conduct the renovation of the Federal Reserve campus, which the president and others have poked a finger at, saying, why is it costing $2.8 billion? Well, the building's 100 years old, and it costs a lot to renovate big campuses in Washington, D.C. these days, but Powell's not in charge of that necessarily either. He just happens to be there at the time. All right, let's talk about tariffs and potential legal challenges. August 1st, I know everyone circled that date because the president has said no exceptions, no exemptions. Howard Lutnick, the Commerce Secretary, reiterating that over the weekend. We got a lot of tariffs going into place as of August 1st. Are there any legal or regulatory challenges that stand a chance of stopping that train from heading down the tracks?
Yeah, there is a legal challenge. The U.S. Court of International Trade back a couple of months ago ruled that most of the tariffs were unlawful. The Court of Appeals then paused that and allowed them to go forward while the appeals are being heard. And the next big date is July 31st. That's the next hearing in that case. That obviously is not going to be resolved anytime before August 1st. And if I had to guess, it's probably ultimately going to end up in the Supreme Court. But the important thing about that case, Caleb, is that it's about the mechanism the president used to impose tariffs. It's not about whether tariffs are a good thing or a bad thing. And even if he were to lose that case, there are other mechanisms available for him to impose tariffs. So I often get questions around this about, well, won't the courts just throw out the tariffs? even if they threw out the way that these tariffs, the emergency authority under which these tariffs are being implemented, there are plenty of other ways that tariffs could be implemented. So I think this is, as we all know, a core part of this administration's strategy. And Caleb, I don't know how you feel about this, but I think there's a chance the market is underestimating the August 1st date. I think we've gone through a few months here where the market is sort of saying the president kind of delays things, or he talks big numbers and then he ends up with lower numbers. But it sort of feels like maybe the market is starting to underestimate the risk here on August 1st, that a lot of numbers are going to jump quite high. I don't know where you think on that, but that's a big concern I have.
I totally agree, and there's some great analysis by your team over at Schwab that looks into that as well. We're going to have gross profit compression. We're going to have margins being compressed. We're going to have companies either absorbing or passing them on to consumers, and ultimately that is going to weigh on profit growth. And as investors, that's what we're here for: profit growth. So when you hear about margin compression, when you hear about potentially companies pulling back on their forecasts or discontinuing some services because of this, it actually gets pretty scary. But now here we are at record highs, and investors seem to be ignoring just about every piece of potentially bad news out there and continuing to buy their favorite stocks. All right, let's look into the second half of the year. I know tariffs is front and center because that's coming our way August 1st, but there's a lot of other things that are probably out there on the legal and regulatory front that you're focused on. Give us one or two that we should have in our minds beyond the obvious.
Yeah, two things I'd mention. First, the next big fight is over government funding. The annual appropriations process is underway on Capitol Hill. That's got a deadline of the end of September. The government's fiscal year begins on October 1st. Congress is nowhere near passing the 12 appropriations bills to fund every federal program, every government agency. And there's a risk, I think, of a government shutdown sometime this fall. So we're going to be keeping a close eye on that. The second thing, Caleb, I think we're going to start to see more action on the deregulatory front. As you look at the SEC, for example, Paul Atkins, I think, has settled into that job. He's been so far doing a lot of sort of what he calls clearing of the underbrush. So they've, paused or decided not to continue with various cases on all sorts of subjects. But now I think you're going to start to see the SEC and other regulators start to think about, what do we want to do going forward? What do we want to do in the crypto space? What do we want to do in the private market space? And start to be thinking more about, what regulations do we need to get rid of to help the market? What regulations maybe do we need to put in place or clarify or update? Some of the private market regulation is almost 25 years old. So I think you're going to start to see a real push on the deregulatory front over the next 6 to 12 months.
Yeah, and we know you're going to be watching it and following it closely. And folks, we urge you to listen to Michael Townsend's great podcast, Washington Wise. Michael Townsend, the Managing Director of Legislative and Regulatory Affairs for Charles Schwab, and a good friend of the podcast. Thanks so much for coming aboard the Express again. Good to see you, my friend.
Thanks, Caleb. Great to see you.
All right, let's get into a little money in motion, because money is moving. We're at record highs here, but we've seen money moving across asset classes over the last few weeks, and that's a risk-on, melt-up environment. You've seen record highs in Bitcoin. You've seen Ether, another big popular cryptocurrency spike. We've also seen just a lot of trading activity in general. Let's get into some of the numbers here. Retail investors in the last quarter bought more stock and ETFs in the first half, actually, 2025 than in any other 6-month period in the past decade. And what have we been buying? We've been buying our favorite stocks: Nvidia, Tesla, Palantir, Robinhood, AMD, and Amazon. You see a couple of chip stocks there, obviously, but we keep piling into the same stocks. You talk about over concentration in the markets. Exhibit A right here: Nvidia, Tesla. Even with the headline risk that Tesla presents, whenever that stock drops, you see a lot of retail investors piling into it. And Robinhood, very popular, obviously, with the crypto crowd, and you've seen that stock surge as crypto has surged with it. The chip makers, AMD and Nvidia, right there. And then what about the pros? What are institutional investors buying lately? And it's not exactly the same list. Institutional investors are just catching up to the rally. Let's check out that chart of institutional top stocks by institutions. Yeah, Berkshire Hathaway topping the list, even though that stock has been underperforming the S&P 500 since Warren Buffett told us he would be retiring at the end of this year. That's a Buffett premium, and that is gone. Coca-Cola, that's a consumer staple stock if there ever was one, and one of Berkshire Hathaway's top holdings, by the way. Chevron, obviously one of big legal battle last week. AbbVie, AT&T, and Abbott Labs. Very different list from what retail investors are buying. And retail investors have been buying dips and buying their favorite stocks really all quarter long and outperforming a lot of institutional investors here when you just look at the purchases. And I love this great chart here from our friends over at Vander Research. Why are we buying a lot of these stocks? Well, people are worried about missing out. That fear of missing out drives a lot of these purchases. When you look at NVIDIA, which is, again, record highs or near record highs, Tesla's been through it all. Palantir, the SoFis of the world. Joby, that is I believe that is an aircraft. It is a flying aircraft, autonomous aircraft stock. A lot of meme stock purchases by retail investors. But we have held in there really throughout the past quarter or so, and really the first half of the year, through all the turbulence. Retail investors stay committed and have been buying. And we see a lot of younger investors getting back into the meme stock game. Be very careful. Those usually do not end well, but if you time it right, control your risk, you might have a chance of making some money there. All right, let's get into what to expect this week, because it is a very busy week, especially as it relates to corporate earnings. Let's talk about corporate earnings, because right now, the earnings scorecard, we got about 12% of the S&P 500 having reported earnings so far. 83% of the companies in the S&P 500 have reported a positive earnings per share. Surprise, surprise, surprise. Companies usually guide low and then deliver high to try to get that premium boost when they report better than expected results. We'll see if that happens again this week. We've got earnings rolling in all week long, starting today with Verizon. Domino's Pizza, one of the best performing stocks of the last 25 years. Thank you very much. Tomorrow, Tuesday, Fed Chair Jerome Powell speaking at a banking conference, and then that's it. Fed goes into a quiet period ahead of its next meeting on interest rates, July 30th. Right now, only looks like a 2% chance the Fed does anything with interest rates, as in lowering them. There's about a 100% chance the president will not like that. More earnings on Tuesday with Coca-Cola reporting, Philip Morris, Lockheed Martin, GM reporting results there. Wednesday, report on existing home sales for July. Guess what? Not a lot of homes are selling right now. We still have mortgage rates at 30-year fixed over 6.5%. Keeping buyers and sellers out of the market. Earnings from Alphabet, Tesla, IBM, and AT&T Wednesday. That is going to be a busy day. What are those companies saying about corporate profits going forward? What are they saying about the health of the consumer? And then Thursday, new home sales for June. They weren't very strong. I can tell you that right now. Earnings coming in from Intel, Honeywell, and other companies. And then Friday, rounding out the day with ConocoPhillips and others reporting results. Big week to focus on earnings. Just a few economic reports to focus on, but really, it's all about results. Can they deliver and can they outperform? Because that's what we're paying for. All right, let's get into the Investopedia. Whoa! Indicator of the week. And you know what I've been watching lately? I've been watching consumer discretionary stocks versus consumer staple stocks. Hey, when the markets were shaky, when we were in that 19% drawdown, investors flocked over to consumer staple stocks, the Coca-Colas of the world, the McDonald's, the Walmarts of the world. Why? Because we don't usually cut our spending on the staples when times are tough or when we get worried about the economy or when we get worried about our own finances. Guess what? Since April 9th or so, when the president gave that 90-day extension on tariffs and has been backing off of them ever since until the last couple of weeks, it's flipped around. It's consumer discretionary stocks that are outperforming consumer staple stocks. And when you see consumer discretionary outperforming consumer staples, and I think we have that chart, then you know risk is on big time. And when I'm talking about consumer discretionary, what am I talking about? I'm talking about even the Apples of the world, Teslas of the world, Carnival Cruise Lines, the things that we want but don't necessarily need. So we've seen this great outperformance. That's the orange line, represented by the Sector Spider consumer discretionary tick ETF, XLY versus XLP. Put these on your watch list. Keep an eye on them. It'll give you a good sense of the risk mentality of individual and institutional investors out there. We're going to watch that closely. And also, we love a good railway story, a good railroad story, and there could be a big railroad merger in the works. The Wall Street Journal reporting that Union Pacific could be in talks to acquire rival railroad operator Norfolk Southern, which would create the nation's biggest railroad company. Nothing like a good train story. We love a good train story here at the Investopedia Express. We could get the biggest railway in the world, and we know that regulations are being eased, especially on mergers. Antitrust is being eased. It could be time for another big railroad, the biggest in the country. We'll keep a close eye on that and all the news that matters to individual and retail investors like us who are just trying to stay smart. Thanks so much for joining us. This is going to be streamed on all your favorite podcast platforms. Throw us comments, throw us reviews. We love it all. Talk to us. I'm up here by myself here at the New York Stock Exchange, but so glad to be with you. And we will talk again a little further on down the line.